Every time markets rally, the same question shows up in my inbox. Is this finally too expensive? Is it the wrong time to be in the market? In this video, I want to show you a simple way to read valuations in 2026, how to look at index level PE ratio, and how to think about sector spreads, and how to tell the difference between uninvestable and just uncomfortable. No jargon, no 40-page research report, just a framework you can actually use. When people say the market is expensive, they are usually talking about valuation multiples, things like the price to earnings ratio or PE. Very simply, PE is price divided by earnings per share. If the index trades at 20 times earnings, investors are paying $20 for every dollar of current earnings. Is 20 expensive? The only honest answer is, compared to what? Compared to its own history, compared to other markets, and compared to what's going on with rates, inflation, and growth. So instead of fixating on a single number, think in terms of where valuations are versus their own past, whether earnings are actually growing or flat, and whether the multiple is doing all of the work or earnings are pulling their weight. Let's start with the big picture. Take the main US index. You've got a headline PE number. That's the average of all its companies weighted by their size. Here's the key. That headline PE hides a lot of variation under the hood. A handful of mega names can drag the index multiple higher, even if most stocks trade at much more reasonable levels. So when you hear the market is at X times earnings, don't stop there. Ask, is this being driven by the top 10 names or is it broad? If the headline multiple is elevated, but the median stock trades closer to its long-term average and earnings across the index are growing, then the story might be a bit pricey, but not insane. But if the multiple is high and all the earnings growth is concentrated in a tiny corner of the index, that's a different conversation. Next layer down is sector spreads. Instead of asking, is the market expensive? You should ask, which sectors carry the highest PEs? Which ones are priced more cheaply? And does that make sense given their growth and risk? You'll usually see story sectors like high-growth tech or certain consumer names trading at higher multiples because the market expects faster earnings growth, and more cyclical or boring sectors like financials, industrials, or staples at lower multiples. What you want to pay attention to is, are the premium sectors priced for perfect outcomes? Are the cheaper sectors priced as if earnings will never grow again? If the premium sectors are pricing in years of double-digit growth and flawless execution, that's where expensive can start to mean uninvestable for you. If a sector is cheaper because nobody wants to think beyond the next quarter, that might be uncomfortable but potentially attractive. Valuation is always a bet on the future. The market doesn't just look at today's earnings, it looks at what earnings could be in 1 to 2 years, what margins might do, and how much investors are willing to pay for that. Here's a simple way to think about it. If PE ratio is high and earnings growth expectations are aggressive, you are paying for a very optimistic future. If PE is in line with the historical average, but earnings are actually growing, you might be paying for a fair price for solid business. If PEs are low, you start to wonder, is this a bargain or is the market correctly pricing in real problems? The main 3 questions every investor needs to ask: are earnings actually growing, or is the index living off multiple expansions? Is the growth broad-based or concentrated in a few names? And are you comfortable owning businesses where even a small disappointment could knock 20 to 30% off the share price? That's the line between expensive but investable and I'm just buying hope. Let's turn this into something you can actually use. Before you call the rally too expensive, run through this checklist. Look at the index, then look under the hood. The headline PE is step 1. Step 2 is, what's the PE of the median stock? Are you paying up mainly for the top 10? Rank sectors by valuation and story. Which sectors are at the top of the PE rankings? Which ones At the bottom, does the growth story justify the spread? Or are you paying a high premium? Decide what level of uncomfortable you can live with. Expensive doesn't automatically mean do not touch. It means size your positions appropriately. Diversify so one story does not dominate your portfolio. And accept that higher multiple names will come with bigger swings. If you're not comfortable with those swings, it is okay to tilt more of your money toward reasonably priced, cash-generative businesses and hold fewer wild tickets. So is this rally expensive? Parts of it probably are. The important question for you isn't are we at an absolute top? It is which part of the market am I actually paying up for? Are those bets intentional? And is this level of uncomfortable something I can live with for the next 5 to 10 years? If you found this helpful and want more data-driven breakdowns of how markets work, not just the headlines, and if you are tired of hot takes and want markets with actual math, hit subscribe and let the algorithm know you prefer facts over vibes.